A strong week for the broad market on the back of a strong week for NVIDIA. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Sonali Basak. We're kicking you off to the closing bell here in the United States on a strong week. We're going to get a check on the markets of where we stand right now, because some of that exuberance is certainly cooling. You have the S&P 500 off of the highs of the day, really, more than 0.1% higher on the day. But the NASDAQ 100 hit a record high yesterday, down about 0.2% today. And the SOX Semiconductor Index similarly down about 0.6%. We are also looking at the two-year yield, finally getting a bit of a bid in that bond market. We saw it fly past 471 yesterday, back down to 468 on the day today, Romaine.
Yeah, a relatively modest day in the markets, but it's still a relatively strong week overall, particularly on the back of NVIDIA. But there's no way to sugarcoat it, folks. About 90 points added to the S&P this week, but a quarter of that gain was, yes, thanks to NVIDIA alone. An additional fifth of those gains, you can thank Amazon, Microsoft, Meta, and Apple combined. Narrow breadth, of course, that doesn't get any better from there. Maybe some investors can live with that for now. The technical analysts on edge with a hawkeye right now on broad market support, broad market levels that they're looking at right around 5,052 to 5,073. That's the main pivot point out there. And you got a 20-day moving average below that around 49.66. That is the bottom pillar, and one that some of those technicians really want to see hold. Now, effectively, what those technicians are looking at is they want to see broader volume. They want to see broader volume to sustain the momentum. Take the short-term trading index, the ARMS index. It compares the number of advancing and declining stocks to the advancing and declining volume. A reading below 0.5, that suggests more upside demand, since that means, well, volume is higher on average on an up stock compared to the down ones. A reading above 2, a sign of investors selling. Now, at one point today, we surpassed 1.7. That means buying pressure still below the threshold of concern and still well below the peak that we hit late last year of 3.7. And that might actually be a good sign here. Strategists over at Citi say global equity returns should broaden after, well, a somewhat narrow first quarter here, a narrow first quarter that's still not over. And they say, though, the stock performance is still going to be heavily dependent this year on the earnings followed through, enough so that they see reason right now, Sonali, for a bit of a cyclical tilt, a growth tilt as well, but definitely more of a cyclical bent.
And let's talk about participation so far, and let's look back for a moment here, because to your point here, not everyone has felt the brunt of this rally. You look at the NASDAQ 100, tech heavy, and the 47% rise or more that it's had over a one-year period, and you don't see the same of the broader indices. Even the S&P 500 up only about 27% or so in that same time frame. I want to point out here in blue here, though, the Russell 2000, so many investors really looking here, Romaine, at the potential for small and mid-cap stocks, for them to finally catch up. And at the end of December, you did see a narrowing here of the bands between the S&P 500 and the Russell 2000 index. But you have seen that start to diverge once again. And there are questions about what inflation means for those smaller cap stocks and whether some of those technology stocks are insulated. We will certainly see whether some of these laggards will start to catch up.
All right, well, let's pick the brain of our first guest, kicking things off to the close on this Friday afternoon with Jeremy Siegel, Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania, author of Stocks for the Long Run, and a market watcher for years and decades now. Jeremy, you've seen it all here. I mean, we talk all the time about your book and just how pivotal that was here, but are we in a situation right now where Stocks for the Long Run is more like, well, 7 stocks for the long run?
Yes, this has been a narrow rally, and I certainly hope it broadens out. I still think the uptrend is intact. I think we're going to get a better PCE inflation reading next week. I think we're going to get a better inflation reading in February. It might quell some of the fears that the Fed is maybe never going to lower rates. And in fact, as we know, there was some talk of maybe even a hike. So I think this economy is still got strength. All GDP projections are coming in ahead of what we certainly thought in December. Yeah. And, the excitement of AI cannot be denied. And it could go a lot further.
Yeah.
Before it settles down.
Why do you think, though, you still have a lot of naysayers out there, Jeremy? I mean, we talk about the potential boost that you could from AI, but you talk about the foundation of that economic data, which still shows a very resilient economy. A lot of people, they're still scared. They're still scared of this market and still scared of what I think they think is going to be some sort of economic cliff.
Yeah, and a lot of people have been saying, "Oh my goodness, is this like what happened in the internet in 1999 and 2000?" And we are not there at all yet. I mean, a lot of the debate that I was in New York last couple of days, and people were saying, "Well, does this look like 1997, 98?" A buildup of that, and I said, "Not yet at all." I mean, NVIDIA, what is it, 35 times forward earnings, and maybe not even that, because I remember 99 and 2000 when we were talking about 100 and 200 times forward earnings, and those were the
Yeah.
ones that were actually earning money. So we are nowhere near that. These rallies have been backed by earnings. That being said, it's rich. You have to look at, you have to beat expectations by a lot to get these stocks to continue to move up. NVIDIA did accomplish that in the last quarter, but we saw a couple of those Magnificent Seven that did not, even though they beat. And that, of course, is the danger once you get up into those
Right.
higher PE stocks.
When we're thinking about the possibility of more breadth to hit the market, for more stocks to start to catch up, what would it finally take for some of the more badly beaten sectors? You think the regional banks, you think some of the housing some of the parts of the housing market here, what would it take for them to feel some love here?
Well, both of those are challenged, to say the least. I mean, because with the strength that this economy has shown, that has surprised everyone. I mean, economists and the Fed. Take a look at Fed GDP projections. We are way above them. They have smiles on their face. Hey, we're in a happy place. I mean, look, we got a strong economy. Inflation is coming down, not as fast as some people had hoped, but certainly on the trend down. There's no incentive right now for them to lower rate. Now, if there's no incentive for them to lower rates, that does challenge real estate. And that challenges these banks, these smaller banks that do make up quite a bit of some of these smaller indexes that we're talking about, because they hold the commercial real estate that has to be rolled over. And, I talk to a lot of people and they say, I don't think I can roll over at a Fed funds rate of 5.5.
Well, it begs the question, Professor Siegel. I want you to comment here on the Fed funds rate for a moment, because the market is still pricing in at least a June rate cut. Do you think, given what you're saying about the PCE data next week, that June rate cut is in the bag?
No, I think nothing is in the bag when it comes to the Fed. I don't think the Fed officials, are in the bag. I mean, before June, we're going to have 2-3 more inflation cycles, job cycles. Things can certainly turn around. We could see exhaustion of the consumer. We could see some of the interest rate challenged sectors begin to depress the market. It just has not happened yet. But I say June is not in the bag, can go either way. And the Fed itself, on March 20th, we're going to get certainly the Fed meeting. And we'll see the dot plot. I expect it to be more aggressive than what we saw in December. In other words, not as many rate cuts as we saw in December.
Yeah, unfortunately, it feels like the market is finally starting to get that message, at least some folks, Jeremy, in terms of positioning. Always appreciate talking to you, Professor Jeremy Siegel. They are Professor Emeritus of Finance at the Wharton School over at UPenn, helping us kick off to the close here on this Friday afternoon. An exclusive interview coming up in just a bit with a big focus on tech and a big focus on AI with Charles Phillips, managing partner and co-founder at the investment firm Recognize.
Plus, our stock of the hour is Intuitive Machines, that Houston-based company behind the first U.S. moon landing since the Apollo era. We're going to look at the business of the space economy, Romaine.
And a new survey out there finds it's becoming harder to earn a high salary when working from home. If you're watching this from your kitchen table or your couch, you definitely don't want to miss that conversation. And so much more coming up in a bit, right here on The Close on Bloomberg.
If you want to make $200,000 a year or more, prepare to dust off your work clothes and report to the office. The latest data from career site Ladders says remote work opportunities for high-wage earners are on the decline. In the fourth quarter of last year, those listings shrunk to just 1 in 10. And joining us now is Bloomberg's work shift reporter, Matt Boyle. What exactly is driving this shift?
Well, I mean, we shouldn't be that surprised that high-paying remote jobs are on the decline a bit, because all remote-friendly jobs are on the decline a little bit. That story also found that job postings in the more remote-friendly sectors of the economy were down 8% versus pre-pandemic levels, versus jobs where you need to be in the office a little bit more, we're still up double digits. So we're not saying at all that remote work is, going away like maybe some people might want, but certainly fewer of those jobs. And let's also think these higher paying jobs, you're probably leading a team. They probably want you to be in more often than not, to be mentoring that team, brainstorming and doing those types of things. So it's not just like you're an individual contributor and you can just sort of do your TPS reports and do that from anywhere.
But is there a broader trend now that even just the trajectory, the career path, that if you are a remote worker, particularly if you're one of these people who is hired in that remote work environment, that somehow your ability, let's say you're not at that 200,000 level, you're well below that, does that mean your career trajectory to get to 200,000 is basically interrupted unless you go back?
There's suggestions of that remain, certainly, and at certain companies, certain CEOs have come out and said, if you want to be remote all the time, that's fine, but don't expect to move up the ladder as quickly as someone who's more willing to come in.
And I assume when the CEOs made that comment, they did it from the office and not from their second or third home.
I would hope so, or maybe not from the golf course. You never know.
Because there's been some messaging that's been a little confusing.
There's a lot of, do what I say, not what I do with some of these comments. But let's say, do you really want to lose a really talented, qualified employee just because you won't let them work from home a little bit of the time? So again, we have to make sure there's nuance in these conversations. It's not black or white.
Matt, what about people who say, maybe I will give up more pay so that I have more flexibility? Are you seeing that still?
That is true. That's been something that really we've seen in the data since the pandemic. People are willing to give up a bit of salary for more flexibility, because that flexibility is worth more to them. Be able to have time with their family, or just pick up the dry cleaning, on a Friday, is worth a lot to them. So depending on the role, yes.
Is there a sense, though, that this is also maybe concentrated in certain sectors, certain industries, even certain geographies, and there are other places maybe in the country, other places where you're not going to have to worry?
Yeah, you raise a good point. I mean, we have to remember there is not one job market. There are job markets.
Yes.
It is a lot different if you are looking for a job as a home health aide versus a job at Walmart versus a job in AI, for example. So yes, a lot depends. You really got to know what are the local nuances of the employers in your area. And are they offering something remote? Then maybe you might be able to be working from anywhere. But more and more often these days, the number of remote-friendly jobs, certainly are on the decline a bit.
Yeah, and now most of us, a lot of us can do our jobs from anywhere. I mean, as long as AT&T keeps the network up.
Yes,
Matt, great to have you. Matt Boyle there, a closer look here at remote work and maybe a little bit of an ebbing here in corporations accommodating those folks, particularly on the higher end of the spectrum. Shonali, we don't have that luxury of working from home. We can't necessarily do this from home, although we've tried. So I don't really have a lot of sympathy. It's like the world's smallest violin, but I understand
had no
other folks.
sympathy for this too, but I can understand. There are people with certain needs. You think about how many people have moved away from the city and have paid for real estate that has been quite expensive and has locked in that mortgage that wasn't 7%, and now they're facing a new reality. Well,
that's the story. Next story I really want to read is those folks who did sort of restructure their lifestyle and where they live around remote work and maybe having to roll that back in a very expensive way. All right, a lot more coming up here on the program with about 45 minutes until we get to those closing bells. A closer look at some of the big market moves on the day, and that includes shares of Warner Brothers Discovery, touching a record low today after results disappointed Wall Street. Jason Bazinet going to be joining us from Citi in just a second. This is The Close on Bloomberg. All right, time now for our top calls. A look at some of the big movers on the back of analyst recommendations. And we got a big one to start off with. Rivian here, a double downgrade today from buy to sell. This over at UBS and a price target going down to $8 from 24. The analysts really pessimistic right now about Rivian's ability, well, to turn a profit with such tepid demand out there for EVs across the U.S. He says Rivian's current strategy is still, quote, quite onerous on cash, and the company likely needs capital raises that could amount to around 30% of its current market cap. Investors didn't like what they heard there. Shares down 10%. Next up, let's take a look at Carvana. Getting a lift to market perform. This over at Raymond James after the fourth quarter earnings did beat expectations, and it comes just a week after the analyst had actually cut his recommendation to underperform. It's an interesting flip-flop here, predicated on what the analyst sees as a favorable retail spreads and structural improvements in Carvana's business. Those shares having a pretty decent day, up 35%. And finally, Fox, upgraded to buy from neutral over at Citi. The analyst Jason Bazinet telling investors that Fox's sports streaming venture with Disney and Warner Brothers is going to be a win that will reduce exposure to secular pressures affecting the pay TV ecosystem. As for concern that customers won't sign up for the service, he disagrees, saying the market may be underestimating the potential impact. Fox getting a modest bid on the day, up about 1%. And those are some of our top calls. We do want to stay with media, and we do want to stay with Citi's Jason Bazinet, who also covers Warner Brothers Discovery. Shares of the entertainment giant touching an all-time low at one point in this session on the back of its latest earnings release. Jason joining us right now. He is the media analyst, internet and media analyst over at Citi, and he has a buy rating on Warner Brothers Discovery shares. Jason, this report left a lot to be desired. 7% drop in sales. What was it, like 12% drop in ad revenue, 18% drop in the film business? Were there any bright spots in this report?
It was pretty tough to find them, to be honest with you. I think what the street was reacting to was disappointing EBITDA numbers in the quarter on every single division. And it missed street expectations by about $300 million. And if you crank through the math on that, the market's reaction, while large today, I think was actually pretty rational.
What's the next step here, Jason? I mean, there's so much speculation, as you know, about what the future of Warner Brothers Discovery is going to look like, whether it's going to be a standalone company, whether it get absorbed into another company, or whether it goes down this roads of partnerships like they're doing with the sports deal with Fox.
Yeah, it might be all of the above, to take Obama's line. I think if it remains a standalone company, I think the trick is essentially to take the $9 billion of EBITDA that they generate in their core sort of networks business, where you see the ad pressures and the cord cutting, and sort of mitigate those losses and sort of make up for it with better results at the studio, where they generate nominally about $3 billion, and begin to generate real profits in the direct-to-consumer business, which today is flat. But the company's talking about that generating about $1 billion of EBITDA 2 years from now.
With that much uncertainty, how much time do you give them, Jason, to really fulfill their dreams, if you will? Is there a risk that they go from a buy rating to something less than that for you?
Well, our thesis, our buy rating is actually pretty simple, which is if you just think mechanically about the street is valuing this firm on an EV to EBITDA basis. And every year, they're taking, $4, $5, $6 billion of their cash flow and delevering. And so you should just be swapping debt for equity. So as long as the EBITDA can remain sort of stable and they're deleveraging, the equity should perform better. The pinch that we're in right now is the EBITDA, of course, is not stable, and it's actually falling and missing street expectations. And that's what they have to turn.
How long do you give them to turn it, though, at the end of the day? You look at some of their growth plans, and it could become costly over time.
Yeah, it could. I think the getting the streaming business to $1 billion isn't a big stretch, because they're going to have a lot of top line tailwinds. And I think if you look at the EBITDA miss that they had this quarter, most of it was in the studio. And for sure, they're going to have a difficult Q1, because you're still going to see the aftershock of the strikes. But when we go through the numbers for 2Q, 3Q, 4Q, the studio should actually turn into a bright spot for the balance of 24, and that's going to give them a lot more breathing room than they had this last quarter.
But when you say a bright spot, you're talking about from a sort of a cost/profitability perspective?
I'm just saying the top line should be a lot better.
The top line.
And yeah,
okay.
Exactly, a lot better. On Go ahead.
I'm sorry, one reason I raised that, Jason, because the concern, too, has been that some of the efforts to improve profitability seems to be coming at the expense of content, the idea of creating less content or at least less costly content. But as you know, of course, in order to sort of keep pace in the streaming wars, you definitely need that content. And it's something that Warner Brothers and some of the other services have definitely lagged, at least relative to Netflix.
Well, that's true. I would say that in Warner Brothers' case, it's actually been misfires more from a creative standpoint, where the content that they've released, maybe with the exception of Barbie, just haven't really resonated with consumers. And when you look at the films that are coming out over the next 12 months, whether it's The Joker or Dune, I think, and I'm just using third-party HSX data, the market thinks those are going to do a lot better. Their studio, the domestic box, they probably did $1.3 billion last year. I think they're going to do probably something close to $2 billion in just the domestic box. And that will go a long way. Not only will it generate profits in the studio, but it should have knock-on benefits for the streaming business as well.
I asked you a second ago about whether they would sort of remain a standalone company. I'm going to ask you kind of the flip side of that. I mean, just knowing David Zaslav's history here, is there any possibility that investors should be looking at for acquisitions by Warner Brothers Discovery?
Well, I'm in the minority on this, Romaine. I sort of think there needs to be another round of consolidation. The buy side looks at the history of consolidation in media and says you can't draw a straight line between M&A and success in streaming. Therefore, they don't want to see any more of it. I think they're just dead wrong. When you go through the math, the combinations, while they didn't generate immediate profits in streaming, it's absolutely the recipe for success. And so any sort of combination that Warner Brothers goes through, I think would be positive in the long run. In the near term, whether it's positive for the stock is really just a function of does the leverage go up or down sort of day one. That's going to be the main thing that the street's going to look for because they don't really believe it will help them strategically in the long run.
All right, Jason, always great to talk to you. Jason Bazinet over at Citi, a closer look at the streaming space, closer look at Warner Brothers Discovery. Shanali, those shares right now at a record low, a company that, remember, when they came public, there was a lot of ambition, a lot of talk that this really could be kind of the Netflix killer. And it certainly got some great content on it, but just not really able to sort of show the profitability.
But even with content, you have to wonder, our own Felix Gillette makes a point, where's Harry Potter this year?
Yeah.
Where are these big hits that could bring in the money when it comes to studios?
Well, I'm glad he mentioned Barbie, which I was not a fan of, but that definitely got everything in the cultural zeitgeist. But you talk about some of these other big movies like Dune and some of the other ones he mentioned coming down the pipe. Is that going to be enough to maybe right the ship? You know, it's like, what do people want to see? Do they want something unique like Barbie, or do they want just, another Marvel or DC Comics
And
movie?
even if you can give them sports, how expensive will that endeavor be if you can diversify well with that big partnership that everyone's talking about? We'll see. We'll see.
All right, we'll keep an eye on those shares here, one of the big laggards here on the day. But when we come back after the break, an exclusive conversation with Charles Phillips, the former Oracle co-president and now the co-founder of Recognize, will be joining us to give his perspective on identifying tech talent and the impact of artificial intelligence. That's coming up next, right here on The Close. This is Bloomberg. Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Shanali Bassick.
Another interesting week here in the market. It's kind of a bit of a breather coming off that monster rally that we had the other day. A rally, of course, that was all about NVIDIA, all about AI, all about big tech.
And it's interesting. We're actually getting a little bit of a rally today in the bond market. You saw yields just shoot higher, but the market really shrugged it off. Interesting point made by our own Gina Martin Adams here, that the big tech players are not highly levered. So that high cost of financing is not going to bite into them in the same way that we're seeing into some other areas of the market.
Yeah, big reason why a lot of folks are gravitating to that space, and now they are really trying to look beyond just the NVIDIAs of the world. They're trying to find the other companies that could benefit from the tech and the AI boom. Incorporating generative AI into the workplace, well, that's a big component of it, and it's drumming up both excitement and fear. There was a recent survey out there from the investment firm Recognize that highlights such cautious optimism among workers, with security as the main concern around the deployment of AI. Workers are nervous about, well, how complex AI tools can be, how to source talent that can manage it, and whether AI can produce fair and accurate data. That's why Recognize works with entrepreneurs to build more evolved tech services company. companies. And I'm pleased to say that Charles Phillips is joining us right now. He is the co-founder of Recognize. He was also the former co-president over at Oracle, as well as CEO, I should say, over at Infor, and sits on the boards of several companies, including Viacom, CBS, and American Express. Great to have you here, Chuck. Let's start off here with just the general idea of, I guess, the hope of AI. We all kind of know sort of the extreme fears. We all know the extreme sort of promises that have also been put out there here. Kind of help us make sense here of what the reality is right now when it comes to how this is going to be used.
Yeah, good to see you, Romaine. These trends take a long time to play out, and sometimes they kind of bump along at the bottom while we solve a lot of the issues you just listed, but then it takes off and it goes much further than you think. I would say I'm optimistic that we can solve those problems, and this will be a lot more positive than it is negative. I think the backdrop is, if you look at where we are economically, we're running out of people to work. And, we have a falling unemployment rate, which is a good thing, but an aging workforce. We have no real prospects for immigration and H-1B visas. And, we have the quiet quitting syndrome. People want to work remote. A lot of things are going on. And so employers complain all the time about not finding enough workers. So I'm not worried too much about, do we have enough jobs for people? Mm-hmm. Do we have enough people for the jobs? And that's where AI comes in to make us far more productive and to make up for some of the gap and, kind of people we can't get to work right now. We just don't have enough population growth to make up for it.
So what's the solution? I mean, we could talk about AI in general, but when you start applying it to specific industries and specific types of companies here, what ends up being that solution? Is it just taking away kind of the lower skilled type, the lower skilled type of task, or is this something that can also be applied to some of the higher skilled tasks as well?
I think you start with the simple things first. I like to say it takes away the drudgery. And so one good use case that I'm seeing in call centers is, if you call into someone at a call center, some customer service person, they're usually searching on multiple computers, multiple applications, trying to find the answer, and basically triangulate across multiple sources, either past data on the web. And so if you could aggregate that in one place, so that person does far less of that and gives you your answer, and more accurately, gives you an answer faster, you also get lower churn. Those are tedious jobs. People don't want to do all that. That's why it's such a high turnover in call centers. So if that's one example, replicate that across many different functions and processes in companies where there are things that people don't like to do, and they could be far more productive if they didn't have to do them.
So most of the companies that Recognize invests in, are they primarily fitting with that general part of the market?
Yeah, we have companies that basically sit in between the core platforms like AI and the end customer that needs to use it. And so what you're looking for is the use cases. What is a good situation where I can use generative AI to solve a business problem that you have, where to make you far more productive, more efficient, more accurate? And so nothing happens unless someone takes that technology and makes it specific to that one company, their specific use case. And so that's what we invest in, the people who understand how to explain that to companies, how to find the use cases, and how to do that in a reasonably cost-effective way.
Is what's happening now, though, materially different when it comes to AI and the other technologies associated with it? Is it materially different than maybe where we were several years ago? I mean, you go back and it's sort of the early days where we started to hear people talk about this, which was quite some time ago. We kind of forget that. And even some of the things that you did on the cloud at Oracle and at Infor and the AI components that fed into that here, what's materially different now than where we were, I don't know, 15 years ago?
That's a good question, because you have to remember, on the internet, on cloud, we went years, a decade or so, where people were skeptical that it would ever happen. AI is going through the same thing. 4 or 5 years ago, AI was a legacy term. You wouldn't use the term because it just wasn't relevant anymore. And technology changes, becomes more excited. Now it's back in favor. We don't mind saying artificial intelligence now. And so in the enterprise, it takes a long time because people adopt these technologies fairly slowly. They're conservative. All the issues just listed around security and all the other concerns. The complicated infrastructure where they have thousands of applications and the data is not consistent, have to clean all that up. So nothing happens as quickly as we'd like to see it happen, but it does happen over a long period of time.
We've interviewed a lot of folks on this show about kind of the ethics behind the rollout of AI and the need to really sort of make sure that it's at least somewhat equitable, at least more equitable than the current state of tech here. And when you look back at the past tech booms, it seemed like it was a much broader type of technology. AI seems very hyper-specific, or at least the way it's going to be applied. How do you make sure that whether you're finding new companies, finding new entrepreneurs, or even looking at the customers that will be on the end of this, to make sure that what is being put out there does sort of, I guess, reflect us all?
That's a fair question. And so I would say that usually this comes up around image recognition, and it has not done a great job of reflecting people of color when it comes to image recognition. It's because it was trained on a different data set. And so the good news is everybody recognizes that the case and trying to remedy that. It won't happen overnight, but changing the data sets and how you train and fine tune these models and changing the images that you use will go a long way. So I wouldn't use it for that right now because of that reason, but for many other text-based use cases, it's very, very productive.
Do you have hope, though, that we are at least moving in what I think would be the right direction?
I do. Like I said, it's in the company's interest to do that. I mean, the reality is a lot more people, the complexion of the country is going to change a lot over the next 10 years, and they know that. So to be accurate and to make the technology relevant and fair, they're going to have to do that. And so they're in catch-up mode on that topic right now. But again, it's going to take some time.
All right, Charles, going to have to leave it there. Really appreciate you taking time for us. Charles Phillips, he's the co-founder of Recognize. We should also note that Charles does serve on the board of Bloomberg LP, the parent company of the network that you're watching right now. All right, we're going to come back and take a look here at some of the big market moves on the day, including shares of Intuitive Machines. You may not have heard of it just a week ago, but you certainly heard of it after the big historic moon landing. It is the stock of the hour, and it is up in a big way. It's coming up next, right here on The Close on Bloomberg.
A commercial lander named Odysseus, powered by a company called Intuitive Machines, launched upon a SpaceX rocket carrying a bounty of NASA scientific instruments and bearing the dream of a new adventure.
All right, Bill Nelson there talking about the historic moon landing that we saw yesterday right here on Bloomberg. You heard him mention Intuitive Machines. That is the company that built that lander, and the shares are surging today. In fact, it's not only the hottest stock of the week, it's, believe it or not, the hottest stock of the year, outperforming almost everything else in the NASDAQ composite. Abigail Doolittle joining us right now to talk a little bit more about what was, I should say, a tiny company. It's now got $1 billion market cap, and looks like that stock is on its way to the moon as well.
Yeah, it is. To the moon, Alice, for sure with this one. It's an exciting moment for sure. And it's not just this landing. Well, let me back up. It is, but it looks like investors had a pretty good sense that this was going to happen, because to your point, the stock up today about 20% at the highs. Actually, it's coming off the highs right now, up 15%. In the after hours yesterday, up 43%. But all the way this year, that 200% gain. So when you see a stock trade well into a big event, a binary event, a lot of people were betting that it was going to be successful. It was nail-biting, though, because right before landing, there were software glitches. And I know, Shonali, that you were watching it and really...
Yeah, it's incredible, because those software glitches, you saw the stock down on the day and then rise after market. They needed an on-the-fly software patch to fix those glitches. Ultimately, you see the stock rebounding meaningfully, as we've been talking about. What does a landing like this mean for the numbers?
So it's interesting, because that, at the end of the day, this really validates this company that there can be a commercial, a private business of spacecraft going to the moon. So NASA paid $118 million for Odysseus. I just love that name. It sort of makes this lander pretty somehow personal, a fraction of what it would normally cost. But it positions them well for future contracts. At least that's what Cantor Fitzgerald is saying. They actually took up their price target to 13 to 4. So what is that, like a tripling? They have an overweight benchmark, says they are now, get this is pretty funny, the preeminent moon player. But the board we're seeing right now on air over the last year, you can see the stock down 53%, some of the competitors also down. So it's not as though this is a clear situation, but at least there's some hope. If you were to look at the numbers this year, $300 million, a loss of 50 cents. But if this company all of a sudden becomes profitable,
And there's been a lot of discussion, too, about this idea that if you want to make an investment in space, that is, there's only so many public companies out there you can do it. Obviously, the holy grail would be SpaceX if they ever did go public. But for right now, I mean, it's companies like Intuitive, and I guess if you still like the legacy companies like a Lockheed or something, you can do that. But the excitement seems to be with Intuitive.
Yeah, the excitement does seem to be with Intuitive. And you make a good point that I was thinking of earlier, which is this probably opens them up for some exciting investment potential for sure. Or even to be, maybe their end goal is to be bought out. Maybe they don't want to take it all the way, but it does seem like they've, gotten the ball further down the field or higher into the sky.
Yeah, and I think that's what a lot of investors are trying to front run if that does come to fruition here.
Yes, and there's a 10% bear short interest, I should say. So some of this is a squeeze, but yes, I think that you're exactly right. There's definitely a speculative
People were
notion.
shorting it? They were shorting the moon?
They were. Can you believe it? How can you do that? Space travel? Why would you want to short space travel?
Yeah, I mean, the moon so far is undefeated, Abigail. Abigail Doolittle, a closer look at our stock of the hour. Shares of Intuitive Machines, ticker LUNR, up 15% here on the day, Shonali, and it's already like almost quadrupled just on a year-to-date basis.
It's absolutely incredible, to your point, just a meteoric rise, if you will. Is it un-American to short the moon, you think?
I think so. I think it should be illegal. I mean, what did the moon ever do to anybody? But in all seriousness, it gets to this idea of the technology, right? And we talk about SpaceX, how for a long time, they were the only ones who could do what they were doing in terms of using those reusable rockets. And Intuitive Machines is kind of in that same position right now. You really only have two companies in the world, this one and one overseas, that at least have proven they have the capability to do this. So if you're an investor, you're going to gravitate.
Not a lot of public market opportunities to invest in space. SpaceX, of course, valuation flying in private markets, but such is the story of the day.
All right, we're about 14 minutes away from the closing bells, closing out the holiday shortened week. Phil Orlando going to be joining us in just a second, Chief Equity Market Strategist at Federated Hermes. This is a close on Bloomberg. This is the countdown to the close. Romaine Bostic here alongside Shonali Bassick with about 10 minutes until we get to those bells. Shonali, coming off of that big rally yesterday, a 2% gain on the S&P 500. It looks like we were going to give that back today, but at least for right now, the S&P holding its own. Not really any material gains here, but I think most people would take it pretty significant for the week.
Ending the week in the green, and you look at the SOX Semiconductor Index, you would think it's the best week on record or something. It's actually only the best week since 2 weeks ago, and it did not see as big of a gain as back then.
Yeah, this was a weird blend of the macro and the micro. You can see your two-year yield still elevated right around 4.7 here, and a lot of idiosyncratic stories on the week. Of course, we saw that with NVIDIA and sort of the flip-flop that we saw in some of the other AI plays where we saw some pretty significant profit taking. Some bright spots here on the day. That includes Hyatt as well as the company formerly known as Square. All right, we do want to talk a little bit more about big tech because, well, it is losing a bit of steam here in the market today. NVIDIA has driven that AI-fueled rally this week, this month, and the year. We had a chance to catch up with Jeremy Siegel over at the Wharton School about the recent moves and whether there's more room to run.
This has been a narrow rally, and I certainly hope it broadens out. I still think the uptrend is intact. I think we're going to get a better PCE inflation reading next week. I think we're going to get a better inflation reading in February. It might quell some of the fears that, the Fed is maybe never going to lower rates. And in fact, as we know, there was some talk of maybe even a hike. So I think this economy is still got strength.
All right, Professor Jeremy Siegel there helped us kick off to the close. And here to take us to those closing bells now is Phil Orlando, Chief Equity Market Strategist at Federated Hermes. And Phil, I mean, when you listen to sort of what Jeremy was saying, when you look at the economic data, you look at the earnings out there, is there a backdrop, a foundation at least, that would sort of provide an argument for more market gains?
Well, Romaine, first of all, thank you very much for having me back on the program. We've got a soft landing thesis. We have not been in the outright recession camp. And you just look at just fourth quarter earnings as an example. The expectation going in to the fourth quarter is that earnings would be up maybe 1 or 2%. It looks like they're going to be up, about 8% year over year. So earnings are surprising. The market is just doing phenomenally well. You're up 25%. Since the bottom of the market last October. We've got to be up 7% just in the first 2 months of this year. Mm-hmm. Now, the concern here our full year target for the S&P is at 5,200. We, as you pointed out, we hit 5,100 earlier today. So we're either going to have to move our number up based upon, improving fundamentals, or the market is going to need to digest some of these gains at some point over the summer and the fall. I'm of the opinion that we are going to have some digestion here, in part based upon the Federal Reserve making some policy changes. And you may have heard we've got this election coming up later in the year.
Yeah.
There tends to be some volatility around that. So the underlying fundamentals are still pretty good, but we've done really well in a short amount of time.
We've done really well in a short amount of time, and with regards to the Fed, we still have to wait, I guess, to March 20th or whenever, when they talk to us again, at least in a formal capacity. In between that, though, Phil, we are going to get some more earnings, particularly from some of the retailers, and that'll give us a better sense into the health of the consumer and whether we're continuing to spend. What are your expectations heading into some of those reports out of like a Macy's and a Bed Bath & Beyond and Best Buy, et cetera?
So as we look at the macro data, Romaine, and I guess we got this about a week ago, the Christmas season was the weakest that we saw in 5 years. That retail sales overall during the October through January period were up 2.9%. Christmas a year ago was up 7.2%. Now, it's just not a random data point. We saw the same trends with back to school last year. We saw the same trends with the Easter Passover season. So the consumer is cautious, particularly at the low end of the wage, skill, and wealth spectrum. Personal savings rates are up. The growth in credit card usage is down. Credit card delinquencies have doubled over the last couple of years. Excess savings are down 86% from the peak of the pandemic. All of that suggests that there's less spending going on, and that's manifested itself in the retail sales.
One thing I worry, Phil, one thing I worry about that data that you cited is how much data we got after the quarter. You mentioned the January period, so some of this won't even be reflected in the earnings reports. Do you think that the consumer has materially softened since the quarter ended, and are you worried that there's a cliff somewhere along the way?
The answer is yes, but remember, Sonali, a lot of the retailers have January fiscal quarters. So some of the weak January may be in some of these reports. So the point I was going to make is that when you drill down to the individual revenue and earnings numbers of the retailers who are going to be reporting here at the back end of the season, some of the weakness that I discussed from the macro data should trickle down into some of the bottoms-up data.
Do you think that it's a problem that some of the equity market has not experienced the same type of gains that we have seen for the Magnificent Seven, or even the dispersion you see here between the Russell 2000 and the S&P 500? What would it take for the laggards to catch up?
Well, you hit the nail on the head. That this rally we saw last year, the market up 24% for the S&P, great year, but it was the Mag 7 that was up 76%. When you look at the performance of the other 493 stocks in the S&P, they were up something like 10 or 12%. And that trend has continued in the first 2 months of this year. I mean, NVIDIA's numbers the other night were just phenomenal. I mean, I can't tell you they weren't great. They were. And the stock did phenomenally well. But at some point, there's got to be a reversion to the mean that in a lot of ways, what's going on in the technology sector right now, or over the last year or so, is reminiscent to me of what happened in 1999 going into the Y2K calendar changeover. A lot of those companies absolutely helped us resolve the calendar cliff, if you will. But by the time we got into March of 2000, investors realized that valuations had gotten ahead of themselves, and there was a pause. I think one of those pauses is going to come up, at some point this summer or fall.
All right, Phil, we're going to have to leave it there. Phil Orlando, Chief Equity Market Strategist at Federated Hermes, helping us count down to the closing bells. Just about 2.5 minutes to go, Sonali. Stocks have basically been in the same pattern that they've been in for a good portion of the day. Fractional losses right now on the NASDAQ, fractional gains on the S&P and Dow.
And fractional, I think, is the key point. You've been talking all day about this idea of really the lack of breadth and also the volumes we're seeing. We'll talk more about it a little bit, but the retail volumes have really been exuberant, but not for the the whole market. It's really just for a few stocks.
Well, on the week, it is still an up week here with all 11 of the S&P sectors holding on to gains. A full breakdown of all the market coverage of the day and on the week as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Sonali Basak. We're counting you down to the closing bell. Here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, originals, as well as our partnership with YouTube here. A bit of a holding pattern in the markets right now, Carol Massar, but still a relatively strong week on the back of yesterday's relatively strong rally.
Yeah.
Relatively is a good way to put it.
Absolutely, right? And fair enough to take a little bit of a breather here. And I keep thinking about the outlook, what shapes it. And I was thinking of a story that's on the Bloomberg about how economists are dropping their odds of a U.S. recession. And I do think about if we indeed do not see any kind of recession, get that soft landing, what that will mean for corporate earnings growth and estimates and providing more support to the equity
When you say
trade.
dropping the odds, what does that mean? They're going from like 52% to like 51?
Expanding at they see the economy now expanding at 2.1% annualized rate this year, up from the 1.5% expected last month. So that's good, more momentum.
But maybe it's also telling that we're just not even hearing people talk about it who are, business executives, people who are market observers who would come on our program. It's not even on their radar anymore like it was a year ago.
And I should say they're marking down their recession odds to 40%. That's the lowest since 2022, Sonali.
It's interesting. It's not just the recession odds that people are getting more optimistic about being marked down. It's the stock market and it's the bond market. The issuance we've seen, I know this is an equity market close, but just the amount of large cap stocks that have issued an enormous amount of bonds in this interest rate environment should tell you that you see bullishness across asset classes over here.
All right, we are getting the closing bells here on this Friday afternoon. A mixed day for the market, but a decidedly up week to be sure. A Dow Jones Industrial Average looks like it's going to close out the day up. Pardon my French there, up 62 points or about 0.1% here on the day. On the week, though, it's also holding on to about a 1% gain. The S&P 500 is going to finish the day higher by about 2 points, right around that 5,088 level as we wait for these numbers to settle. At one point on the day, it did trade above 5,100. The Nasdaq did move lower on the day, down about 45 points or about 0.3%, while the Russell 2000 modest gains on the day, 0.1%.
All right. Wait, go ahead. What?
I wanted to talk about sectors as well here for a minute here, because we did have a few that were down on the day, but nothing too crazy here, Carol. We had energy down about 0.5% on the day and consumer discretionary as well. But utilities, materials, and industrials leading the way here. So you did see some more participation in the S&P 500 that was marginally higher, finally to close the day.
All right, folks, let's get to, those were the sectors, so let's drill down a little bit more and get to some of the individual gainers in today's session. I'd be remiss if I didn't bring NVIDIA into the mix once again.
Did that rally today?
Well, it did at one point. It was up about 5%, finishing the day with a 0.4% gain. So that's, I believe, good enough for a record again.
If it's green, it's in the record.
Okay, all right, we'll take it.
Wait, where did we settle? Let me just pull it up here. 1.97 trillion.
Yeah, we were on that
cap.
$2 trillion market cap watch. Not quite going to get there today, but I mean, it seems inevitable at this point, Carol.
Well, what's interesting, it was definitely a different kind of week for NVIDIA versus Palo Alto. Remember, it got hammered earlier in the week. Well, Palo Alto is your number one gainer in the S&P 500, top gainer in the NASDAQ 100 as well. Heavier volume based on the past 20 days. So we did see a move up in that name, up more than 5%. Didn't see any real news. There was a big block trade that we did see come across the terminal. So I just thought it was interesting that we did see investors coming in.
That's just dip buying, right? I mean, that's sell-off early in the week. I mean, I understand what the concern was, but that was overdone.
But I agree, right? It's not like the stock is coming undone or the company's coming undone. It was just kind of a bit of a valuation reset.
Yeah.
Got to mention Carvana. This one.
Do we?
Let's pull it up. Well, come on.
Are they still around? What's going on?
32%. It was up more than 41% at its highs today.
Okay.
Biggest gain in about 2 years. The online used car dealers, fourth quarter adjusted EBITDA and EBITDA margin and gross profit all beat the average analyst estimate. They've been reworking their business. Obviously, investors, some enthusiasm. Big run up in last year's trade. So we continue to see some investor momentum.
Up
Even if you do not buy it.
last year.
I know, I kind of
1,000%.
played it down.
But look, there were questions about whether this was going to be a going concern the year before. So.
I also think there was a decent, I got to pull it up, but I think there was a decent short position on this one so that when they came in better than expected, it's a 32% percentage of float, outstanding shares that are being short.
Look at all that red
and
next to you, Carol.
What?
The decliners.
Just because you weren't here yesterday and you're trying to cram in extra.
Was there a show yesterday? Oh.
It was a great show, by the way.
I'm going to get us back on track and talk about what was happening on the other end of the S&P 500. The biggest decliner in the index today, Booking Holdings. We covered the earnings yesterday after the close. Fell the most in 20 months. Shares falling today by more than 10%. This after the company gave a disappointing forecast for travel reservations and gross bookings. We noted this all day, the war in Israel and currency fluctuations weighing on results. For the full year, the company expects gross bookings to increase slightly faster than 7%.
Did they really blame the war in Israel?
Yeah, they did. They said it would not. It knocked like a couple percentage points off.
Oh,
At least in part.
Yeah, I mean, look, it does. This company has a much bigger footprint in Europe than its competitors.
Yeah.
So
good point.
Yeah, worth keeping an eye there. Warner Brothers Discovery, the second worst performer in the S&P 500 on a percentage basis today, hit an all-time low. The company reported fourth quarter revenue and profits that fell short of Wall Street forecasts and declining TV ad sales. Also weakness in its studio business. Here's what David Zaslav said on the earnings call. The business is not without its challenges. Among them, we continue to face the impacts of ongoing disruption in the pay TV ecosystem and a dislocated linear advertising ecosystem. We challenge our leaders to find innovative solutions. Curious to see what those solutions are going to be, given all the disruption that's happened in the space over the last few years. Finally, Rivian. Another day of selling when it comes to Rivian shares, down more than 12% today. This after it fell 25% yesterday. Shares down close to 40% so far this week, all after that disappointing forecast for 2024 production, and also announced that 10% reduction to its workforce. This all happened late Wednesday.
All right, let's take a quick look at yields here. We did see some oscillations there, though the volatility that has typically been sort of indicative of this market tamped down just a little bit. Going to close out the week on the two-year yield just below 4.7, not far off from where we were to start the week. Down, we should say right now you're looking at the yields in that move that we saw, only about 2 basis points on the shorter end of the curve. But when you go further out, you saw a lot more activity there. 7 basis points lower on your 10-year yield and about 8 basis points lower on your 30-year yield on the day here. So you get a better sense here of where investors' heads are at, a little bit less about the reaction function of the Fed and a little bit more in tune here to, I think, what we were talking about a little bit earlier, and that's a revision of economic expectations.
All right, we have to talk about the week that was in the role of NVIDIA. Having said that, you know how I like to do this. What do you think was the best performing name in the S&P 500 this past week?
It was Garmin, wasn't it?
No, Discover Financial.
Oh. Okay.
NVIDIA was the fifth best
That was
performing
so
stock.
Tuesday.
That was so Tuesday. But it's interesting, even though with the bump up, remember, NVIDIA leading into that earnings report, we saw, 4 consecutive down days. So there was some negative sentiment leading into it. And then, of course, that blockbuster report. But I do think about NVIDIA and how we were talking with our Tom Giles, who covers the Bloomberg technology team, and just the impact of AI more broadly, certainly machine learning and how it could impact so many different industries. But then we got that story of that incredible tie-up of some really well-known individuals. What was it? Amazon, it was NVIDIA, and some others in terms of AI and robotics, which I feel like we haven't talked a lot about, but the possibility of what it could do in terms of our society.
I was out at a supply chain conference a couple weeks ago, and one of the things that was really shown off there were these sort of animatronic kind of robots that could lift boxes, unload a container, and things like that. It was amazing how many folks were showing off those, both the big companies, the ones you would expect, like a Boston Dynamics, but also, of course, names like Figure AI and some of those smaller companies as well.
Yeah, and Figure AI is the one we're talking about because we had the story this afternoon that Bezos and NVIDIA are investing in the company to the tune of a $2 billion valuation. And it makes these humanoid robots. And I made the point with Tom Giles a little earlier, Romaine, and this is to your point about the supply chain conference. It makes sense that a person like Bezos would invest in this. I mean, imagine warehouses for Amazon filled with these rather than human beings. I mean, the company actually makes the point of saying, okay, we're Figure AI, and what we're investing in is the idea that there is a labor shortage shortage.
Yeah.
That's happening, not just in the U.S., but throughout the world. And this is going to fill that gap.
What was interesting, though, too, and not to get too off track here, but some of the demonstrations I saw, they were talking about just how much more advanced the technology has gotten. And I remember Boston Dynamics gave me this presentation. They were talking about how in the old days, you know, the robot could just basically stick its arm in there and pull something out. Now it can just open up the back of a truck or a container. It can sort of read basically the size of everything in there, determine the weight of everything in there, and then pull everything on or off in, I guess, an efficient manner, much more efficient than what Tim Senevic would be able to do.
Can they do gainers and decliners? Can they do
testing.
gainers and decliners? That's what I want to know.
Tim, if they start doing that, we're all in trouble.
They
So
definitely
we're in
can.
trouble.
When they can do gainers and decliners.
All right. Well, we're safe until all of this comes to fruition. Hey, guys, don't forget Berkshire annual report and also the shareholder letter from Warren Buffett. So that'll happen tomorrow. So don't forget.
Yeah.
So get up, get a cup of coffee, and read it tomorrow.
Are you going to have full coverage of that tomorrow? Bloomberg Radio and television?
At home with my puppies. Yep.
Okay.
I'll read it to them.
You and I both.
All right.
Are those
That's a
puppies
wrap.
Munger and Buffett? Is that what?
Not exactly.
Okay.
All right, guys. Have a safe weekend. That is a wrap. Our cross-platform radio, TV, YouTube, and Bloomberg Originals. We, of course, will see you same time, same place on Monday.
All right, welcome back to Bloomberg Television. We continue our coverage here, and it's Factor Friday. We're going to break down the factors that fueled this week's market moves with Chris Kane of Bloomberg Intelligence. Stick with us. That's coming up next here on The Close on Bloomberg.
Welcome back to The Close. I'm Shonali Bassick alongside Romaine Bostick, looking at some key things in this market after the market close here. You have to take a look at just how much exuberance we had and who participated in that. A lot of questions about the increased role of retail interest. So I talked to Citadel Securities here. They gave me what they were seeing in terms of average daily value of volumes of shares traded across the broader market. And what was interesting is that it was actually down in the days before and after that NVIDIA report for the broader market, but NVIDIA alone was up 25%. It really goes with that narrative here that it's single stocks that institutions were targeting at a greater scale here, and institutions were as well following their lead. Now, also, when we talk about breadth, I want to show you what it looks like when we look at the equal weighted index of the S&P 500, and you think about U.S. exceptionalism and just how far this market has flown. But when you look here at that S&P 500 equal weight, it's actually falling behind the stock 600 when you look at it in terms of how you're doing more broadly in the market here. It's not as rosy as you would initially think. I also want to look at it in one other way here. I want to look at it for smaller and mid-cap stocks in the Russell 1000 Value versus Growth Index. Even among the small and mid-caps, just check out the divergence you're seeing here. Over the past year, you're seeing the growth index rise closer to 42% in that Russell, but the value index really lagged behind. Again, there are periods where you saw more divergence than others, but value has not caught up. There are plenty of people in this market looking for value, but they have not yet, Romaine, seen those gains.
All right, closer look here at some of the market moves that we saw this week. And let's, I guess, go a little bit under the hood here at actually what drove some of those moves. It's Factor Friday with Chris Kane, equity strategist for Bloomberg Intelligence. And Chris, you've been taking a look not only at the big moves that we saw this week in stocks, but once again, another week where we saw yields move higher as well in the bond market.
Yeah, we've been really inspecting the correlation between stocks and bonds, and it's pretty interesting right now. So the first thing you really have to know is that the correlation between stocks and bonds is very high. The correlation between S&P 500 and longer duration treasuries is about positive 0.8 on a rolling 12-month basis. That's very high. To the intermediate term treasury index in S&P 500 is a little lower, but still very positive. To put that into perspective, when you look at the average rolling 12-month correlation over the last 50 years for stocks and bonds, it's basically zero. Wow. So it's very high right now. And when you look at the data, what's really interesting is you kind of see two big regimes. You see 1970 to call it 2000, which was generally higher correlation between stocks and bonds, and then 2000 to 2020 was generally lower, and in the last couple of years has been higher again.
So do you think it decreases from here, that correlation? What would cause it to do that?
I do, Shanali. I do think it's going to decrease. I mean, the thing that we found that corresponds the most with the stock bond correlation is just generally inflation. So when inflation is high, what you see is the stocks and bonds be very correlated. We've seen it over the last 2 years. You saw that in the 70s, right? And then when the inflation is lower, you see the correlation be 0 to negative. As you know, with CPI, we've gone from 9% in June 2020 all the way down to 3.1%. If you go past that 3% level, which is the average over the last 50 years, that corresponds with a lot lower correlation between stocks and bonds. That and the fact that it's so high right now makes it logical to think that it's going to decrease.
What's the implication of that, Chris?
So the biggest implication would be just for your standard investor, your standard 60-40 investor, which is basically everyone that invests in stocks and bonds. You know, what you want is a low correlation. You know, sometimes it doesn't feel good, but having a low correlation between stocks and bonds just, you know, has diversification work for you, decreases the risk of your portfolio. If you change the correlation from an assumed 0.4 to minus 0.2 between stocks and bonds, that decreases the volatility of a 60-40 portfolio from basically 11% to 9%. And on a Sharpe ratio basis, that's about 20% increase. So it does have a pretty big implications for those investors.
All right, Chris Kane, who always has his finger on the pulse of what's moving the market, a closer look at those factors. Factor Friday with Chris Kane over at Bloomberg Intelligence. Well, that is moving the markets. There is going to be a lot of discussion over the next few days about, well, what's moving the needle in politics. Voters are going to be hitting the polls in South Carolina tomorrow here in the U.S. for the Republican primary. Nikki Haley is facing former President Donald Trump in the state that she used to run as governor, a state which she's trailing the former president by 25 percentage points in the polls. Andy Blocker is the global head of public policy at Invesco. He joins us now from Washington, D.C. for, I guess, a preview of what to expect, Andy. I mean, should I expect anything other than Nikki kind of just having to hand it to her all over the weekend?
Well, Romaine, I think you've hit the main point here. I mean, she may be the former governor, but this is Trump country. South Carolina is Trump country, and I think he's going to show it. The polls, I think, will reflect what happens. I mean, there's one chance for her, and that is that their independents and Democrats may vote for her and kind of tip the scales to get it closer. But even if she wins South Carolina, she has to move into Super Tuesday, where that is really stacked in Trump's favor.
Well, let's talk about that. Super Tuesday on March 5th here in the U.S., Andy. I'm curious, like, what is Nikki Haley's sort of long game right now? Because it's clear in the polls that she's trailing Trump pretty much in almost every state that matters here. But she's made it clear that she continues to try to raise money and that she will continue to stay in this race. Why?
Well, I think the number one reason is she has the money. She's clearly got backers who want her to stay in to the end. And as long as those backers have enough money to keep her in, she'll be in. Other than that, I'm not really sure what the rationale is, unless she thinks something may happen to Trump along the way. Maybe he's convicted in court and can no longer run. But I don't see a conviction even stopping him from running. There's nothing in the Constitution that prevents it. And I'm not sure that the Republican National Committee would reject him if he has the most delegates.
You know, it's interesting. On one hand, we're watching these in near term, the primaries, we're watching Super Tuesday. But when you think about the longer term here, we're already talking to investors, Andy, about what 2025 might look like if you do face a Trump presidency. How are you talking to investors about the risks under a second term?
So historically, we've always said, if you look historically, there's no real difference no matter who's the president as far as the market. So if you're in the market, you need to stay in the market because you might miss some really good days. I think the biggest difference is going to be volatility. Under Trump, there'd be much more volatility, both domestically and some of the statements he makes, and the market may move on a certain day. But overall, I'm not sure it changes trajectory. And then internationally, there'll be a lot of volatility, whether it's our relationship with China, our relationship in the Middle East, and whereas with Biden, it'd be more measured. So, but overall, as far as the market, we don't see the macro move of the market changing. It'd be more like micro moves in a day or two.
Now, how do you think about government spending until the election here? It's interesting because coming out of the South Carolina issues you're seeing over the weekend and any potential questions around the race itself, you do see questions around government funding as well as a flood of issuance just next week. Do you think bond markets can start to get choppy given that there is no impetus to rein in spending just before an election?
I think that's a good point. So, look, I think a couple things need to happen for there to be pressure to actually have government move towards some kind of deficit reduction. I think number one, the only recipe for deficit reduction going into the new year would be if there's split government. I don't see all Republican or all Democratic government with the president, the House, and the Senate in one party having the discipline to do to reduce spending. However, if there's split government, there can be tension there enough, and then that combined with polling numbers, which would match that, where it is a top number. Where the last time we saw that was around 2010, 2011, it was around over 60%. Right now, it's only around 50. It's moved up from 40, but it's only 50%. We get above the 60%, maybe there's enough movement.
Well, I want to get your thoughts then on Mike Johnson and his shepherding right now of his party and really of the House as a whole. We're facing another budget deadline a week from today, I believe, Andy. And at least based on the last votes, or the lack of votes, I should say, it doesn't appear he has a complete handle here on his caucus.
Yes, Romaine. I think there's a lot of reporting coming out of the leadership retreat that he's had where people like the fact that he listens, but they're really looking for leadership. But the problem he has is the same that former Speaker McCarthy had, and that is that there are a number of people in his conference who will essentially do a motion to vacate the chair and remove him as Speaker if he doesn't do exactly what they want. And part of what they want him to do is not put an omnibus spending bill on the floor, not do a supplemental for Israel, Ukraine, and Taiwan, things that kind of need to happen. So he's in a tough spot.
Andy Blocker, Andy, it's nice to see you. Happy Friday to you. That is Andy Blocker, the head of public policy at Invesco. Now to global politics. Tomorrow marks 2 years since Russia invaded Ukraine, and Bloomberg's Samuel Etienne gives us an update on what's changed in Ukraine since the start of the war.
2 years on since Russia launched its widespread invasion of Ukraine, the UN has recorded over 6.3 million refugees, with over 3.7 million people internally displaced. But there hasn't been much movement in terms of territory gained and lost. The land operation has not delivered long-term success, in contrast to naval efforts in the Black Sea, where Kiev has managed to unlock part of the sea route for exports. Now, in a bid to turn the tide of war, Ukraine has changed its commander-in-chief. President Zelensky selecting Alexander Syrsky, the former head of the ground troops there, to lead the armed forces. And military aid continues to flow into the country, with the US committing over $44 billion, dwarfing the UK and EU figures. But changing attitudes to support for Ukraine is a key risk for the next 12 months. In a US election year, former President Donald Trump and Republican Party members are questioning just how much longer the US can continue to support Ukraine financially. All of this as Russia has become emboldened and re-intensified its campaign in the east of the country.
All right, a look back there at what is going to be tomorrow, the 2-year anniversary of the start of the latest war in Ukraine. And when we come back after the commercial, we're going to take a look back at, well, another big milestone. That was back in 1972, and Nixon's gamble on China and the economic boom that was seeded by his unprecedented visit. And we leave you with a question before we go to break. While we know that the U.S. is China's largest trading partner among countries, what U.S. company imports the most goods from the Asian nation? The answer when we come back. This is Bloomberg. Welcome back. It was on this week back in 1972 when Air Force One touched down in Beijing and Richard Nixon became the first sitting U.S. president to set foot in mainland China. It was an audacious visit that broke, well, several decades of hostility and would shape U.S.-China relations for the decades to come. Margaret McMillan's 2008 book, The Week That Changed the World, it details a trip that was, well, less pomp and circumstance and more cloak and dagger. It was a trip that Nixon had been planning secretly for at least 2 years. Even more curious was that Nixon's agenda largely focused on national security interests, such as containing the Soviet Union and ending the war in Vietnam. And I say curious because the biggest legacy of that trip was less geopolitics and more macroeconomic. In fact, trade and economic issues weren't on the agenda at all. And why should it have been? The leader of the then $1 trillion economy breaking bread with the leader of an isolated nation with just $4.5 billion in foreign trade? Well, whether intentional or not, the focus on military issues helped to tamp down conflicts in the region, which paved the way for a multi-decade economic boom in East Asia. It was a boom built on the back of foreign trade. Chinese foreign trade that ballooned from $4.5 billion in the 70s to more than $6 trillion today. To put a finer point on it, and it goes to my question, Walmart, the US-based retailer, ended up doing more trade with China than any other corporation. And Walmart imports so many goods that if it were a country instead of a company, it would be a bigger Chinese trading partner than even Canada or Australia. But the road Nixon helped pave has been pockmarked by the combative stance by U.S. President Donald Trump and an extension of those more stringent policies, if not in practice, certainly in sentiment, by the Biden administration. The decades-long lowering of trade barriers, it's now flipped to, well, a years-long increase in trade tariffs and bans on U.S. companies from even transacting with companies like Huawei and ZTE. China's leadership now making a fresh push, though, to try and mend fences and boost foreign investors' confidence in the country. State broadcaster CCTV reported on Friday that the Chinese premier actually led a cabinet meeting that looked at measures to attract more global capital. It's a meaningful effort to stem a drop in net new direct investment from foreign businesses, which last year hit the lowest level since the early 1990s. We'll be back in a moment. This is Bloomberg. It's time now for our Next Up segment, where we highlight the entrepreneurs, the founders, and of course, the people that fund them who are moving the needle for our economy, our markets, and our technology. Our next guest is using his previous experience to help vulnerable communities get access to digital banking services. Wole Coxum is joining us right now. He's the president, CEO, and founder of a company called Mobility Capital Finance. And Wole, I mean, a lot of people already knew you before you ended up at Mobility Capital. You had a long career on Wall Street, at Citi, Willis, and of course over at JP Morgan. You left that all behind to start this company. Why?
I left it all behind. I was inspired after the murder of Michael Brown in Ferguson and the racial reckoning that overtook the country at that time. And I wanted to use my time and talents and experience to try to figure out how to uplift communities and bring a path to financial opportunity for communities that have historically been left out.
That's a laudable goal. Is that a business plan, Wole?
Absolutely. Because one of the things that I think you got to be able to demonstrate is an ability to make money in a sustainable way while solving a real problem. And if we have a market failure where you have so many millions of families in this country that do not have access to bank accounts and high quality, low cost banking services. So we wanted to figure out a way to create that business. And I think we've come up with an interesting strategy.
Well, is it the system itself that's failing, or is it the lack of the ability for companies to reach more communities? Or initiative, rather?
Well, no, I think so many companies have the interest in trying to move people forward. And one of the things that we found was there's a significant amount of resources that have been allocated for low and moderate income communities that just aren't getting to individuals. So what we figured out was if we can help cities, states, the federal government, not-for-profits, and others get those resources to folks efficiently using digital tools, then those individuals are in a position to be able to move forward on the economic ladder. And so it's a win for everybody. And because we're using market forces and technology, we can do it in a way that allows us to make money too.
I want to talk about one of those initiatives in particular, a very high-profile initiative here in New York City, where the city had been planning to give prepaid debit cards to hundreds of migrant families through Mobility Capital Finance. But that plan has received a lot of pushback as well, amid a lot of concerns about migrants being given kind of a free check here. How do you feel about that pushback, and how have you been addressing it?
I don't want to get into the policy side of things. That's a conversation that you can have with Washington, or you can have with Mayor Adams. But at the end of the day, we've got an inefficient process, or a process that can become much more efficient in terms of getting food to individuals. Instead of having food delivered, we can put those resources in the hands of the individuals, which is through a debit card, which is less expensive for the city. It can significantly reduce the cost of providing resources to individuals. These are tax dollars that are being spent anyway. And for the individuals, it gives them a sense of choice. It allows them to purchase the foods that are appropriate for their diets or their palates, and at the same time puts money back into the economy. It's a great example of why Mobility Capital Finance, or MoCaFi, exists, because it fulfills a policy objective while at the same time improving the lives of the underlying individual.
I certainly understand the potential benefit for a MoCaFi going down that road here, but does this pave the way for a longer-term relationship with these folks? I mean, you mentioned this is taxpayer money. This isn't really a loan. This is effectively money coming out of the government's pocket, out of our pockets, if you will, here, for a group of people that we don't necessarily know what their future is going to be in this country.
Well, the money is being spent anyway, right? So the tax dollar is supporting the overall well-being of people who have come to this country seeking asylum. And so our opportunity as a company is to ensure that those individuals are able to have better choice and put money back into the economy, which is good for all of our tax-paying dollars, and at the same time allows the city to be much more efficient and save those taxpayer dollars so they can be used for other purposes. But I think the real interesting opportunity here is not only are we helping this segment of the population, but we're reimagining getting financial services to all communities, whether it's folks who are elderly, who are unbanked. One of the things you've got to remember is that 80% of the bank branches in this country have closed in low and moderate income communities.
Right, yeah.
So you've got levels of people in parts of New York City who have some of the highest unbanked rates in the country. And so imagine the financial capital of the world having unbanked individuals. We're better than that. And MoCaFi is demonstrating a path forward to make everyone.
How far are we down that path, though, Wole? Because I mean, I've had this conversation in years past, decades past, if you will, about the underbanked and those folks who didn't have access. And we've had over the years a few companies that have cropped up looking to solve that problem. Some of those companies aren't around anymore.
Oh, absolutely. But the wonderful thing about technology over the decades is it allows us to reimagine providing a low-cost infrastructure. And as I mentioned before, there are a significant amount of resources. Just in New York City alone, there are $5 billion that are left on the table every year for low and moderate income New Yorkers. And
I'm sorry, when you say left on the table, that's money that would have been spent? Is that the idea?
No, it's money that's been allocated. So, for example, the Fair Fares program there are 800,000 New Yorkers that are eligible for the reduced fare program in New York City Fair Fares. Only 250,000 people take advantage of that program. And now, as you know, the Metro card is going away by the end of the year. And it's going to be replaced by people who have bank accounts. So if you're one of the New Yorkers, there are 10%, 12% of New Yorkers in some neighborhoods who don't have a bank account, and you're supposed to rely on the Fair Fares program, how are you going to take advantage of that?
Yeah. Have you talked to the city or any other authorities here about being part of that when that transition takes place?
We're talking to everybody who'll listen, from the city to community groups, to make sure that they're aware that there are alternatives for people to take advantage of the resources that the city has available to people.
Are you in talks at all with any other sort of government agencies outside of New York State?
Oh, we're so excited. We've been working with the city of Los Angeles. We've been working with the county of Los Angeles, St. Louis, the city of Birmingham, San Diego. So we're in over a dozen cities across the country because people understand and see that if you reimagine technology for people, you can now move communities forward in ways that we haven't done in the past.
All right, well, I'm going to have to leave it there. Really appreciate you taking time for us. Wole Coaxum, he's the president, CEO, and founder of the company Mobility Capital Finance. Shonali?
We're going to take a look at how the markets closed on the day, Romaine, because it was a stellar week and it was a muted day. We have the S&P 500 that was roughly flat on the day, but still slightly in the green. We had the 10-year yield back down to 4.25, a little bit of a bid in the bond market there. The dollar, we also watched a little bit of a bid fall back into the dollar as well. And New York crude ending 2.6% lower on the day, just below that $77 at $76.56. This is the close on Bloomberg.
All right, the hottest show on Bloomberg is An Optimist's Guide to the Planet. And it focuses, the latest episode, on plastics. Around 50 billion plastic bottles are sold each year in the U.S. alone, and less than 10% of plastic waste is recycled globally. One molecular biologist, though, may have stumbled upon a solution to the plastic problem through observing wax worms.
First glance, it seems like the worms are just eating their way out of the bag. But a closer look shows that something in the worm's saliva naturally degrades the plastic.
Within the saliva, we identify two proteins, so we call them enzymes. Here, we're trying to produce the enzymes using yeast.
Yeast?
Yeast.
Okay.
You can use them in bacteria or yeast. You can produce them in a lab. These enzymes, we tried the enzymes on the plastics, and they degraded. Now, for the time being, we produce in small scale. It's a bit expensive, and we have to work on that to lower the cost and do it in large scale. But that's it. We have the enzymes.
With a partner, Federica founded the company Plastic Entropy to develop solutions based on her discovery.
And that was Nikolai Koster-Waller, of course, the host of Optimist's Guide to the Planet, and the person he was speaking to in that video. Federica Bercottini. She's joining us right now, the co-founder and the chief technology officer over at Plastic Entropy, which, as you see there, the main technology involves those worms. And Federica, just let me know, is the myth around this actually true? That says that basically you were out looking at a beehive or something, you picked up some worms, put them in a plastic bag, and then noticed later that there were a bunch of holes in it. Is that how you got this idea?
Actually, yes. Well, yeah, that's how it happened. The idea of looking for small invertebrates capable of degrading plastic bags was there in my mind. So I tried different little animals, and they all died, unfortunately, over the years. And then when I stumbled in these, it was by chance. So I saw the holes, and that when everything started, yes.
So then what do we know about those enzymes or whatever chemicals that these worms are producing that leads to the breakdown of the plastic?
This is the key question. What is the mechanism behind that? We are studying that. We don't know that much. We know that there are lots of these enzymes in the saliva of the animal, so they produce it and they spit it out for whatever reason, maybe defense. And we are studying how they are able to do that, to break down this plastic film. We are in there. We don't know that yet, actually.
You alluded to the cost tied to doing this at scale. How long would it take to really start to mitigate those costs and create a system that can do this at a bigger rate?
Well, it depends very much on how many people work on that. So on the funding, depends on what we find, also the discovery. I mean, how the project will proceed. But usually in these things, how much people can work on that, how many people you can put on there, you shorten the time. It's always this relation. So I cannot answer. I hope really as soon as possible, because we try to reach a goal here. So let's see.
How much interest are you getting? Bring us behind kind of the conversations about the people who are noticing you doing this work and catching on to the idea that it could really reduce a lot of waste in many geographies around the world.
So it's not that easy, because clearly funding is the most difficult part. And it's not that easy because the industry around the plastic world is not very receptive, at least to this kind of solution, biodegradation, for the time being. I hope this thing is going to change. There is a lot of interest. It's a field growing, increasing. This kind of biorecycling together with the chemical recycling. I mean, I think we should go together. And we are not there yet in terms of also interest, because funding is very limited. So. Yeah, getting there, hopefully.
Are we going to get there fast enough? I've seen some statistics out there, Federica, that shows that globally we're only recycling less than 10% of the plastics out there.
Yeah.
I also saw that the amount of plastic we're producing, which I think is around like 450 million tons a year, is still going to go up to like 1 billion over the next few years. So it's not like, there's a lot of catch up we have to do here.
The prediction for 2050 is scary. Yeah, you're right. I don't know. So recycling, 10% or maybe less. It's not really the mechanical recycling we're using now is not really working as we would like it to work. But there's not much solution out there. So we need to make an effort. Everybody, we need to make an effort to whatever solution is on the horizon, implement it. Maybe produce slightly less instead of increasing that much. That would help as well. In terms of solution, yes, we need to make an effort altogether. Yeah.
One great thing about this docu-series is the optimist part of it. They made an effort to reach out to the people and the scientists who really do see the promise of human beings being more in sync with our environment. And this is a big discussion right now about the regenerative nature of nature, I should say, and the idea that we haven't really harnessed that for our benefit. Is this that opportunity?
I believe so. I believe in it. So nature is giving us a tool. Let's try to take advantage of that. We can use it. We can refine it. We can really exploit it. So yeah, we have to take that away. I hope so. Yeah, that's the message.
Our big thanks to Federica Bertocchini of Plasticentropy. And tune into an Optimist's Guide to the Planet on the Bloomberg app and Bloomberg.com and airing on Bloomberg TV and all Bloomberg platforms. And it's time now for the top three. Every day, we do a deep dive into the people at the center of today's top stories. And up first, we're going to talk about Joshua Pack. He is the co-chief executive officer of Fortress, and he's expecting, Romaine, more U.S. banks to fail as commercial real estate begins to work its way through lenders' balance sheets. He's one of those many private asset giants really starting to see the cracks really forming under the surface.
Yeah, I'm really fascinated by this because we've heard this from a lot of folks here saying that the banking crisis that we had last year really wasn't the crisis, that where it's actually going to sort of take some time to play out here. But I do wonder, do we need to worry about real contagion, or is it just going to be confined to these banks?
Well, he doesn't think so. He thinks that stress is not systemic, and you're going to see more consolidation. I would say some of these guys, it is in their interest to start looking at this. He's starting to pay 50 to 69 cents on the dollar for the loans. So you are starting to see a floor being created in this market.
All right, a closer look at the co-CEO of Fortress. I'm keeping an eye on Jeff Bezos. We did learn a little bit earlier that he's joining the likes of NVIDIA and OpenAI to invest in a business that's developing human-like robots. I guess for a man who basically built one of the biggest logistics and warehouse companies out there, because let's face it, that's what they really are here, having those humanoid robots. Here's one here, Shonali, to help maybe unload and unload things up. Could be a game changer.
Yeah, it could be a game changer. And you have to wonder what that means for jobs. If you're thinking about the mind share that AI could take, what happens when NVIDIA starts taking to the human functions as well?
Yeah, but, I mean, they're going to take, the jobs that are, easier to do. You know what they can't take away?
Your soul?
Wow, you went deep. I was gonna say, you can't go out on tour like Beyonce or Taylor Swift. That was my segue to our third person.
Well,
but Shonali, we should talk here. You want to get on the couch and we can bring in the psychotherapist?
I was talking about more soul, and that soul isn't Beyonce, right? I mean, this is my real optimistic story here. Beyonce becoming the first black woman to top the Billboard country chart, and that's after her new single, Texas Hold'em, became the country's #1 song. Fun fact, Romaine, Kaylee Lyons and I listened to this in commercial breaks together.
So this was the song that she released right after that Super Bowl commercial, right? Is that the idea? Or one of the songs that she released? And so this thing's already at the top of the charts. She's already promised us a country album. Is that what we're getting out of her?
And, it's interesting, too. It's not just the country album you could see from her. It's the attire. Have you seen her rocking the cowboy
good for
hat?
her. I mean, and she's been, in fairness, Houston native. She's done country songs before. And there's been a lot of talk, a lot of spotlight about the contributions of Black Americans to country music. Of course, everybody remembers all the love that Tracy Chapman's been getting after Luke Combs just put her back on the map. And that was just really great to see.
I've been listening to that on repeat, too, I've got to say.
Yeah, absolutely wonderful there. All right, still ahead. Stick with us. It's going to be a busy week next week, and we're going to set you up for all the potential market-moving events. That's coming up next here on The Close on Bloomberg. As we wrap up this week, a look ahead to some of the big market-moving events, and a big one is going to be the PCE inflation data. Anna Wong joining us right now from our D.C. bureau, who helps lead our Bloomberg economics coverage. And we all had that big, scare a week ago when we saw the CPI and PPI numbers. What do you expect out of PCE, Anna?
Yeah, so both the CPI and PPI numbers suggest that the core PCE inflation is going to run hot in January. We are expecting a 0.4% reading, and in fact, Powell's super core, which is the core services excluding housing's inflation measure, is even going to be hotter at 0.6%. So I don't think the market will like this number.
Well, speaking of the market not liking this number, how much does this matter create volatility for the market next week, given that there are a lot of concerns about even a reacceleration of inflation moving forward?
Well, in the same report as the PCE inflation, we are going to be looking at personal consumption numbers. And I think what the market would like about this is that it's going to show a slower pace of spending by households. So I don't think that the number in there will support the no lending story. And furthermore, I mean, if you look at the yield curve this week, it actually further inverted, with the shorter end being higher and the longer end 10-year treasury yields actually ending the week lower. And usually that is a signal of more weaknesses to come rather than a no lending story.
That's interesting, though. And so this gets to the idea, though, that all of those folks, Anna, that had been pricing in rate cuts, multiple rate cuts, I should say, we're now having a discussion not so much about rate cuts, but about the potential that we could actually see a hike at some point this year. Is that ridiculous?
Well, our FedSpeak model, which is based on NLP and machine learning read of Fed's speeches, has been flagging a 13.3% of a rate hike. But our human judgmental read of the situation, which incorporates forecasts, right, such as we think that given the household balance sheets are weakening, that spending would be going to slowing as well. So we do expect multiple rate cuts this year, still 125 basis point. But that said, I would say that generally the market is pricing like our machine learning model right now.
All right, man versus machine, person versus machine. Anna Wong, I always love talking to you. Anna Wong, who leads our economics coverage down there in D.C. A lot of other big events as well next week, Shonali. And we're actually going to start on the weekend because 2 events on Saturday, one in South Carolina. Yeah, those
South Carolina primaries, certainly a big deal. We know generally how it might shake out, but still it sets the tone for the rest of this election cycle, particularly heading into Super Tuesday. We're also, of course, going to reminder here that we do have that grim anniversary, the 2-year anniversary of the start of the war in Ukraine. We're also going to go back to economic data here in the U.S. The PCE core deflator that Anna was just talking about, that's probably going to be the big headline number of the week. It's also sandwiched between a lot of Federal Reserve speaking. So let's see how much we get before and after that. That can react a little bit to the new data. And don't forget, at the end of the week here, we do have that U.S. budget funding deadline. Remember, once again, there was a big question here about whether we end up in a government shutdown or kick the can down the road. And we also get some earnings next week as well, Shonali. Amid a weakening consumer, if you will, tons of retailers ahead. I know that's something that you're very good at covering. It is a competency, I would say, and it's something that people don't watch enough. Lowe's, Macy's are 2 of the big ones that are going to give us a nice read on consumer spending. Norwegian Cruise Lines could also be interesting as well here to see how travel holds up. Really appreciate you joining us here this week. Tune in next week for full market coverage right here on The Close, right here on Bloomberg.